Hey everyone, I'm Bob McCranie, and I'm the broker and owner of Texas Pride Realty. And I want to walk you through today a presentation we're doing to help people protest their property taxes in the state of Texas. So I'm going to share my screen here. And basically, what we have is Texas is a no income tax state. We don't have an income tax. So pretty much all the revenue that is made from the state and the counties is through our property taxes, our ad valorem taxes. So let me run you through this and show you a little bit about what we do. We run a website called protesttexastax.com. Let's run through an example of a typical homeowner. Okay, so I used Fisher Price people because they're fun. Steve bought a house from Stephanie, June of 2015. He bought it for $210,000. So the mortgage on his house was $200,000 at a rate of 4.5% for 30 years. The estimated taxes for the year is $3,075. So when he has a typical house payment on this mortgage, he's going to pay $1,013 towards principal and interest. In your house payment, you have what's called a PITI payment, PITI, principal, interest, taxes, and insurance. So your principal and interest part on this note would be $1,013. Now that amount will never change throughout the whole 30 years of the note. Now, when you look at that $1,013, the amount that you're paying towards taxes versus principal, that will slide over time, but the whole nugget would only be $1,013 a month. Now, on top of that, you're going to be paying towards your taxes. You're going to be paying into an escrow, estimated at $256,000, and that's included in your monthly. And then you're paying your property insurance as well. So his total house payment for this house would be $1,379. And the taxes and insurance go to the escrow. The principal and interest go back to pay the mortgage. Okay? So at the time that this house sold, Stephanie over here on the right, Stephanie would have owned the home 152 days of the year. The estimated taxes were $3,075. And since she owned it 152 days, they would take that per diem for the taxes, which is $843, times the 152 days. And Stephanie would have credited Steve $1,280 at the time of closing. That would show up in their closing statement as a credit to the buyer to cover his closing expenses. Now, in the closing, the buyer is going to put money back into his escrow, build that up, so that the taxes can be paid at the end of the year. So these are all based off of estimates of what the taxes are due, and this is very common for the seller to give in the proceeds the seller's share of the taxes that will come due at the end of the year. So let's talk about escrow and why do banks do escrow? I found a little banker Fisher Price man. I was so happy. So banks want to be sure that nothing destroys a house or hurts the house where they can't come get the house back from you if you don't pay for it. So the insurance has to be paid. The bank, if you don't pay for insurance, the bank will put insurance on the property at a substantially higher rate than you would be wanting to pay. So any sort of fire, tornado, flood, whatever, hailstorm, Texas, whatever you have that could destroy the house, you need to have insurance on it. So part of your PITI payment is paying for the insurance. Okay, the other part of the payment is paying your taxes, because the only lien that gets in front of a mortgagee is the tax man. So if the taxes aren't paid, the government can foreclose on the property and defeat the mortgage lien that's on the property. So the mortgagor is going to be sure that the insurance is paid up and the taxes are paid up, and that's why they build this escrow fund up. If it does not have enough escrow, they will come back and tell you, hey, we have a shortage and we're going to make this up. So let's talk about the difference between escrowing your insurance versus escrowing your taxes. Okay, think of insurance like you're at McDonald's. You pay for the food first and then you get to eat the food. Okay, so you pay for your insurance first and it lasts the whole year, but you have to pay it in advance. You don't get to eat the food before you pay for it. So when Steve bought the house, he paid for one whole year of insurance ahead of time. And then in his monthly payment, he's paying the subsequent year. He's building up the payment for the subsequent year, so it renews. Insurance is paid ahead. Taxes are paid in arrears. So think of taxes like you go to IHOP. You eat the food there, and then you pay the bill on the way out the door. So taxes are paid after you've enjoyed the time in the house. the insurance is paid before you enjoy the time in the house. So that's why taxes are always an estimation versus knowing exactly what it's going to be. So this slide goes through what was put into the escrow at the time of closing. Steve would have brought his first year of insurance and put that in and paid it directly to the insurance company. And then he would have probably put 2 months worth of escrow payments into the escrow account to start paying for the next year of insurance. Stephanie would have credited her taxes towards the escrow, and then Steve would have probably paid 2 more additional months in his closing costs, and that would build that escrow account up real heavy for him. So let's look at an escrow proration or projection for this. So if Steve bought the house and we did everything we just said, he's going to put in, the $1280 from Stephanie to fund the escrow. Steve's going to put 2 months of insurance in and 2 months worth of taxes in. So that's going to build the escrow fund up to around $2,000. Every month that Steve pays in, he's paying a share towards the escrow. In December, when the taxes come due, they're going to pay the taxes out of this escrow, leaving you an amount of $767 in there. And then we build back up. And a year after he bought the house, the next insurance payment will be due. Since he bought the house in June, the insurance would renew in June. Since he owes taxes in December, that's when the taxes will come out. So this is just a regular projection of what an escrow account might look like. And if you have a mortgage, you see this all the time. So this is very standard, and this is what happens when you own a home. So in Texas, you have to file your homestead exemption. Homestead exemption is something that says this is my domicile. Okay, so Steve has between January 1 and April 30th of the year that he owns a house to file his homestead exemption. So if he bought in June 2015, Stephanie already had a homestead. He's homesteaded under her homestead through the end of December. Come January 1 of the year he owns the house and he occupies the home, he can file January 1 through April 30th of that year and register this as his homestead. Now, homesteading gets you, it helps you enjoy some benefits from taxes, and it also protects you from debtors. So I'm not an attorney. If you have questions about that, we can get that for you. But it protects you from a lot of debt collection issues, and it protects you from higher taxes. So it's my understanding, again, I'm not an attorney, it's my understanding that if you owe somebody a debt, they can come take care of your assets, but your home is protected. So if you have that question, consult an attorney. So let's talk about the tax cycle. So taxes happen in 4 phases, okay? They don't just all happen at once. So phase 1 goes from January to May 15th. And during that phase, that's when we have, come here, slide. That's when we have oh, my slides don't want to work. This is lovely. So this is, during this time frame is when we're going to have the book made of all the properties in the county. So from January 1 to May 15th, all the properties that are in the county get put into this basically Sears wish book of properties. The county goes through and says, here's all the properties in our jurisdiction and the values of each of those. So they set up the appraisal value of each of those properties for the county. And they send out a letter to you that says, we think your assessed value is this and your market value is this. And you get that letter usually in March timeframe. And they assess you your new value. And you have up until May 15th to protest that. So during the appraisal phase, you have the opportunity to get the value that they think you're worth and the assessed value, and then you get to protest that and say, I disagree. During May 15th to July 25th, that's what we call equalization. During that time frame, the protests are heard, and that master list, that wish book of properties is updated. So as you go into protest or your neighbor goes into protest, they may adjust one up or down as we go. And by about July 25th, they complete the catalog. They've made all the updates for anybody who protested. They've adjusted things, and they have sealed the catalog, and it's good to go. From July 25th to October 1st, during the assessment phase, that's when the municipalities, the water district, the taxing entities get together and say, okay, now that we have the list of properties that are in the county, and out of those, these are in our district, what does our tax rate need to be to match our budget? So during the assessment phase, the county and the city, the county sends the properties to the cities and to the water districts and to the school boards, and then they go around and say, okay, now that we have this amount of property and this valuation, what do we want to tax them at what rate? So we can protest the appraisal phase. We cannot protest the assessment phase. That's usually, 7 city council members or 5 school board members talking to a consultant, an advisor, and they set the rate based off the valuations established in the appraisal phase and equalized in the equalization phase. Then it goes to assessment, and they say, okay, we need this much money to make our bills work, to pay for all the bonds that we issued, and to handle everything we need. This is the rate we need to set. And then collection takes place October 1 through January 31, and the cycle starts over. During the collection process, the different municipal and city boards send their tax bills together, and usually it's one tax bill, sends it to the homeowner and to your mortgagor and says, please pay us this out of the escrow. It's your responsibility to be sure it's paid. So go watch your escrow balance and be sure it drops by the right amount. Because if it's not paid, then yeah, it's on you. So we have 2 areas that we can focus on that we can help each other with. This is the appraisal phase and the assessment phase, okay? The appraisal phase, like I said, is when they get the whole master list together and they send you your values and they say, this is what we think that your home is worth. The assessment phase is when all the municipalities get together and they decide what rate they're going to set, okay? So your homestead exemption should help knock down the assessed value. It's not going to affect market value. There's 2 different things, market value and assessed value. We'll go into that in just a minute, okay? And so in this slide on the left, obviously you have the appraisal and how it's happening, and the assessment, and the various boards and groups that you could have assessing you. Depending on where you live in the state, you could have a water district. If you're not in the city, you might have a water municipal district. You might have a public hospital like Parkland Hospital in Dallas County. You might have Dallas Independent Schools or Plano Independent School District. You might have the community college system. Dallas Community College System is paid for partly in taxes, and that's great because we need colleges. So these are just different entities that could be part of your tax bill. The most I think I've seen on one property is 6 entities. So, and that was in the Houston area. So let's roll back the clock a little bit and talk about Homestead. The Homestead Act, it's my understanding, started in 1839, and it was started because it was real easy to, have the farmer and his wife get swindled out of their land. Some debt collector comes along and says there's a debt on the land, and golly gee, I'm taking your whole farm. Or the farmer goes into the city for the weekend and gambles the farm away, and the wife is left penniless because she had no say in it. Homestead requires that the land cannot be taken, your domicile cannot be taken for debt collection other than for a mortgage or a tax lien. Again, talk to a lawyer if you think that's a problem. I'm not an attorney, but that's my understanding of it. So it sets up your domicile as a safe place to not be taken. It also gives you, in most cases, some tax relief. So let's look at 2 things that come out during the appraisal process. One is market value and one is assessed value. So market value is if you put a sign in your yard today, hopefully it says Texas Pride Realty, what would you sell your home for? Market value is not the same as assessed value, okay? Assessed value is what can we tax you at? Assessed value, under the current law, the assessed value can go up 10% a year. They're capped at 10%. There's a new bill coming out that may cap it at 3.5%. I have not heard whether that's formally in place yet or if any of the counties and cities are going to sue to prevent that. So I'm sticking to the 10% rule right now until we know better. So the assessed value tends to trend behind market value. Market value is up here, assessed value is down here because they just can't push it up high enough unless you sell the property. And once you sell the property to the new person, if they can find out the value that you sold it for, they can jump you up to that. So let's look at the different, one more thing I want to cover. Market value and assessed value. Let's say that your tax appraisal district has a market value of your home of $285, and you could sell it right now for $325. Don't you dare walk in with a $325 protest because those comps are going to kill you. We don't want to do that. We want to talk about assessed value here, okay? So let's see why it's important to protest. Let's take 3 houses here. One's on Banana Street, one's on Apple Street, one's on Orange Street. So each of these houses started in 2007 for $110,000, hypothetically. The Banana Street house, that person never protests their taxes. That person just pays whatever they're told. It goes up 10% a year in assessed value. The Apple Street, they protest every other year. Every other year, they fill the form out and just mail it in and try to get it. So their assessed value goes up, instead of going up to $259, only goes up to $215. In the Orange Street property, they protest every year, but every 3rd year they fail. Every 3rd year, the board says, nope, we have to raise you. So every 3rd year, they don't get anything shaved off. In 10 years, their assessed value is $179. So this is how we end up with the disparity up and down the block of the same neighborhood over a 5, 7, 10-year span. If you're in a new construction neighborhood, it's going to be really hard for you to protest the taxes because you just got the property. It's going to be whatever it was sold to you for. And once you have a 5 to 7 to 10-year trend in a neighborhood, then it gets to be a really different appraisal between houses because some people protest and some people don't. So let's talk about the appraisal process. Here's what they can appraise you for. They can take the market value of their property if you just sold it. Or if you didn't sell your property, they can take 10% of the last year's appraised value plus that value, so 110% of last year, and any improvements you've made to the property. So that would be if you added a pool, if you added a shed, if you put in a circular driveway, something that really changed and added value to your property, solar panels, things like that. It is not the same as replacing an existing fence or replacing an existing roof or something of that nature. It's not replacing something that's expected to be there or something that it just aged out. It's adding something new, okay? So in this case, we would have 10% of the previous year's value plus the previous year's value plus the improvement, which is a new shed in this example. So those are the 2 ways that they can establish value. One, if you purchase the home and they can figure out what you paid for it, and 2, taking the previous year, adding 10%, and then any new improvements. Now let's talk about how they find out what you bought and sold the house for. When somebody sells a home, the county gets a notice because the home transfer is filed in the county records. And the county will send the seller a letter. Dear, Stephanie, so sorry you moved out of the neighborhood. Hoped you like living here. Could you tell us what you sold it for? And then they send a copy also to the buyer. Hey, Steve, so glad you moved in. Think it's going to be a great neighborhood for you. Tell us, what did you buy the property for? They send it both to the same address, and they hope that the one for the seller forwards. Okay? And I know this because a member of my family got divorced, and she got a copy of the letter in her old name and her new name. So they send it the same address and hope it forwards to the other person. So it's not required that you give them this information. And actually, it's probably not to your benefit to do so. Texas is a non-disclosure state. Every deed should say for $10 and other consideration, Steve bought a house. For $10 and other consideration, Steve bought a house. The other consideration is $210,000 other dollars. But that doesn't go in there. There are ways of figuring it out. If you take Steve's mortgage note, which is filed publicly, and do the math backwards, you can get a pretty good thumbnail idea. But it's supposed to be a non-disclosure state. So we covered that. It does not include normal maintenance like roofs, fences, things like that. So this is a list of seven houses here. So I will confess that my house is the one on the left here. So in this scenario, I was the highest appraised home in the neighborhood because I didn't know any better. These are all the same floor plan. So if you're in a normal subdivision, your floor plan was probably built every 5th house. The builder used the same 5 or 7 floor plans. They may have a different facade, but it's basically the same house inside. So all of these are my floor plan. In the first year, 2010, between the lowest one here on Avignon and the highest one on Steinway, you can see the difference was $36,000 right here, okay? And as we trend up, there was about a $30,000 difference every year, and I didn't know to protest until I protested in 2016, and unfortunately, this one on Carillon sold, and they bounced him from going up 10% to the new sale price. This person should have protested that year and said, you know what, take me back down to 10% of the previous year's person, because you now have me way out of alignment. You're not assessing me fairly against the other homes. So this is what happens when a sale takes place. Somebody doesn't know to protest, and they start taking them up 10%, 10%, 10%. This year here, there was a $91,000 difference. I am hard pressed to tell you, between one floor plan to another, unless one house is burnt to the ground and the other one is gold plated, how you can justify a $91,000 difference on the same square footage house within a block of each other. And that's where I think we have a case to go to the appraisal board and say, hey, my valuation is unfair compared to the others in the neighborhood. Now, here's the same chart that I was just showing you, but instead of looking at it as dollars and cents, we look at it as how high the assessment went up, what percentage. The year that the one sold, it went up 131%. The year I protested, this last year, I kept it at the same as the previous year, 100%, 100.84%. They were supposed to try to take me up about $12,000. I got them to only keep me at $2,000 improved change in value. To me, that is a major gift, because I held it where it was versus letting it accelerate. So those are the things that we try to do, is try to give you the information to go in and fight. So let's look at the graph here. You would expect that as the square footages on the bottom go up, that the value on the left side would go up, correct? It should create a pure diagonal line across this graph here. As your square footage goes up, your value goes up, correct? That's not how it happens. You'll see here, one of the highest square foot houses is one of the lowest assessed value. Some of the median ones are super high, and then these in the back are trending low. And the part of this is that people, one, don't protest, and two, the appraisal district learns the valuation of what it sold for and jacks it up. So this is just a scatter graph of how these property values get out of whack. Here's another one, similar neighborhood. You would expect that the higher square footage house would be the highest, and then the lower square footage houses would be lower. This one here at 1840 square feet is totally below market, and either they're protesting every year or somebody's asleep at the wheel. And so you've got, this one's assessed at about 215, 217. This one here, same square footage at 247. I don't understand how somebody could honestly say there's that big of a difference between the same houses on the same block. So these are the tax rates. These are using my home here in Carrollton. I'm assessed by the Denton County Assessment Board. I'm assessed by the City of Carrollton, and I'm in the Louisville ISD district. So one thing that you might also be added into is a highway district, a college district, a water district, a hospital district, things of that nature. Now, let's talk for a minute about annexation. So let's say that, as our suburbs, especially in the Dallas-Fort Worth area, are expanding, there's pockets of unannexed land around us. And let's say that the city you live in wants to grab this parcel of land that's being developed by a builder. And let's say the builder, right now they're a municipal water district because they're not in the city yet, but the city, town elders say we should go grab that and annex it in. While they're unannexed and the developer is in charge, they can form a water district with one person living on the property. They put a trailer out there, they move one person in, they have a water district. That one person then votes to put the water district in debt to go get the water and build the tower and everything. So they have a large debt that one person or two people voted for. When the city annexes that land and says, okay, now you want to be part of the city, that debt gets spread out across everyone in the city. So it doesn't stay with the land, it gets spread out into the municipality. So the city council may think this is a great idea, we're going to get a property tax base going forward, we're going to take these 200 brand new homes and bring them into our city, but the city residents end up swallowing the debt for that developer who was creating that water district that was feeding those people. So just look at development around you in a different light. Look at the city around you and see what it's doing. The other thing to look at is almost every large business that moves into town gets some sort of tax abatement. And our cities will fight with each other to see who can wrap the biggest gift up for that company. If you get a new big box store on the corner, or you get a new corporate headquarters in your town, they're not paying the full tax bill that we are. So and if you look on the tax appraisal district, you'll see that they have a tax bill. But from what my understanding from talking to some of the city council members is, they get the tax bill and then they send this certificate that they have that they print off and says, see, our taxes are covered because you gave us this, get out of taxes free card. So when we look at their taxes on the tax assessor's database, we don't see that it's free, but there's a back end channel that they're not paying all the taxes on. So a business can get taxed on their physical square footage, on the desks, chairs, computers, everything in their office. I know that corporations are paying taxes, but we don't have visibility into what they're paying compared to what we're paying. So just something to think about as you're watching your city develop and new companies moving in, and how great that is for all of us. And we just brought this new neighborhood into the city. Think about, oh my gosh, what does this do to my tax base? Hopefully it doesn't do too much, but it can. So right here, these are the rates that I'm being charged in my city. I say that because I want to show you that as property values have gone up and assessments have gone up in the area, these entities have actually gone down in their rates. So they look at that wish book of properties in, let's take the city of Carrollton. The city of Carrollton gets their wish book of all the properties that are in Carrollton, and they can say, you know what, because the property values are going up so much, we can drop our rates just a little bit. So it's two sides of the, take this like a little twisty balloon that you make an animal out of. If you put pressure on the 10% cap and bring it down to 3% so that they can't go up, guess what's going to happen to rates? Rates are going to explode. So you've got pressure on both sides here. We can protest our valuation. We cannot protest really the tax rates. So that'll be intriguing to watch. So here's, sorry about the phone there. Here's some tax things to look at here. So I pulled up different subdivisions in the Carrollton area. High Country, there are two houses here within 100 square foot of each other. Their assessed values are $145,000 difference. I'm hard pressed to find out why they're so different. Now, one thing could be maybe one of them has a military, exemption or something like that, but it's hard to figure out why $145,000 difference in assessed value. Another street down the way, two houses, very similar square footage, identical square footage, $39,000 difference here. So Rosemead Edition, this house is actually 40 square feet larger, and it's assessed at $68,000 difference. That's 40 very expensive square feet. Here's another one where it's very similar square footage, just slightly different. There's about 50 square feet difference there, and it's $55,000 difference for that house. These two are almost, they're 6 square feet apart, $32,000 difference. And in this case, this one's actually larger than the other, and it's $51,000 assessed value difference. This is where I think when we protest and help you protest, this is what we can go against. Okay, so let's see here. Unfair appraisal is, I think, the best way for us to fight these values. If you go in and say my market value is not right, right now market value is really good because our market is going well. It's going to be hard to win that debate. What most companies do is, or most people do, is they go to their favorite real estate agent and say, send me current comps, and they walk in with the current comps to the tax appraisal district. The tax appraisal looks at the comps at like 350,000, and you're assessed at 280, and they go, no, you're nowhere near. Sorry, go home. We're going to leave you where you are. You don't want to fight against market value. You want to fight against unequal appraisal, and that's where, when one property is $50,000 difference and they're right around the block and they're the same square footage, you can say, hey, this is not fair. We need to bring this down. Okay? So let's talk about the appeals process. I found Little Fisher Price dogs to be the panel here. The appeal process is you go before a board, and there's two things that can happen. One, you send in your documentation either online or in paper, and you say, I want to either have an offer sent to me or I want to go before the panel. And in the last several years, they have been flooded with protests. So they will call you and offer you something. If that offer is valuable enough to you, take it. If you want to go in and actually protest, then do that. Our service, what we do is we give you the packet of information to go in and protest with. We interview you, we ask you what's wrong with your home, take in pictures. They won't take anything off of a thumb drive or a cell phone. You need to take 4 copies in, and we will give you the packet of what the assessments are and what the valuation should be and what you should ask for, and couple that with the pictures that you're going to describe all the things that are wrong with your house. The fence is falling down, the roof needs to be changed, the grass is all dead, there's dents and bangs in all our walls, whatever it is. We have a leaky roof. Whatever it is that's wrong, the air conditioner doesn't work, document it. It's whatever's wrong with your house January 1. So let's say on January 1, your HVAC is dead, and you repaired it in March. It's what was wrong January 1. So take that invoice in that you replaced it in March and say, here's $5,000 I paid for the air conditioner, take it off my value as of January 1. So that's important to remember. So we're going to put you through the interview process, and what we do is we come up with a packet of statistics and valuations for you to walk in the door and feel confident to walk up to that board and say, here's what's wrong with my home, and you need to drop my value. We are not the company that will take on walking into the panel and doing it for you. There are other companies out there that do that, and bless their hearts, that's great for them. We want to make you strong enough and give you the proper documentation to walk in. And it's good to do, because if you don't have the right documentation and you walk in with market value, you're going to be out the door and not get anything you want. Okay? Now, this is important to remember. That board does not have to change anything. If you've got 3 people on that board who have all had a bad day and you present the best package ever, they don't have to change anything. There's no promise that you will get anything out of this, but we will set you up for success. So what we do is we look at assessed value, not current comps. We look at square footage comps to be sure that everything is spot on with what you're going for. We look at other exemptions to be sure that we're not comparing your home to one that has a different set of exemptions, or that we're inadvertently comparing you to something that it shouldn't. We look at accessory units, we look at pools. We look at rental units in the neighborhood, which I don't know anybody else is looking at rental units. We try to determine how many non-owner occupied homes are in the neighborhood, because renters don't keep up neighborhoods the way that owners do. Rentals are notorious for bringing down value. I also look at vacant homes. I look at these, postcard in the mail sales companies. Oh yeah, we'll put a sign in front of your house and sell it for nothing. And those homes are vacant for months and months and months, not cared for, not mowed, and that brings down values. So I try to look for vacant homes in the neighborhood. I grab the previous year's assessments, and then I manually go update it with the current year's assessments. You cannot go grab current year, you have to manually go get this, and it takes me about an hour or 2 or 3 to do one of these. Okay, we also try to help you find any deficiencies, which is what I was talking about. What's wrong with your home? Is the carpet deteriorated? Is the flooring broken up? Is the foundation bad? What was wrong with your home January 1 that we can go to the board and say, look, you should not look at me as being gold plated, we need to bring this down. Okay, so the packet, we look at, like I said, we look at the different valuations, we build you a graph, we build you a spreadsheet, and then we say, we think it should go for this. So in this case, we looked at the previous year's taxable value and established what the rates were. And then we looked at the proposed value for what the city, what the county was saying you should go to. And instead of going to 225, they wanted to go to 247. We suggested they come in at 229. And that would only raise their bill, instead of raising their bill $38 a month, it only raised it $7 a month. But here's the thing, the future value of money is if we can hold them back at 229, they can't jump that further later. Okay, so let's look at what we have been able to do. Because of the house here in Peters Colony, the proposed valuation was 247. They got it held at 229, so they shaved $18,000 off their assessed value and $376 off their price of their taxes. Now, over 10 years, let's say they never protested ever again, that knocking that value down, the future cost of money, gives them a substantial decrease in their taxes over time. If they hadn't changed anything, they would be paying substantially more. Okay, Vista Oaks here, $28,000 reduction. And so that's a $604 reduction in the annual taxes. Again, over 10 years, that is going to just keep multiplying out. Over here on Steinway, this is my neighbor. She saved $28,700 off of her property, and she went in with a full catalog of things that were wrong with it. We set her up and gave her all the information. She walked in and took care of it. She got $607 off this year's taxes, and over the next 10 years, that's going to save her thousands of dollars. Keller Springs, this was an investment property, so we only compared this property to other investments. This one we got $28,900 off of, and saved him $820 off of his taxes this year. Now, he didn't have any homestead exemptions. This was an investment. So again, over 10 years, that savings is just going to multiply because we took it down this year, and even if they don't protest ever again, that knocked them back so that over the next 10 years, that valuation is just going to keep adding to the value of the home. So protesttexastax.com is our site. What we're doing right now is between now and January 1, what we're asking you to do is pay half now. We charge $150 to do a packet for you. I know that between March of next year and May of next year, my phone will ring off the hook. This will be like owning a toy store at Christmas, and I will be flooded with requests for help. What I'm asking you to do is pay half now. Let me get your packet together in the off season, and then come March, we can just plug in your new valuation, print the papers, and you can be first in line to protest. You pay the other half in March, and we're good to go. I got my license to do this year, and I was helping people for free before to just kind of feel out how this worked. And I can tell you that on May 15th, I got probably 8 or 10 calls from people. Please help us. Oh my gosh, we just realized it was too late to do anything. So what I'm trying to do is get people to book up early so that I can have their packets put together and ready to go. And then come March 1st, we just put in the new value and print and go. So check out protesttexastax.com. Again, my name is Bob McCranie. I'm the broker and owner of Texas Pride Realty. I am a licensed property tax specialist now, and I would love to help you protest your taxes and keep your PITI payment super low so that you can continue to afford your house. Take care. I hope this made sense. If not, ask below in the comments, and I'll try to get back to you, and I will talk to you later. Bye-bye.